Welcome back, everybody, to VTS Options. So in the investing world, the vast majority of people who are trading stocks, indexes, or ETFs, they're mostly on the long side, which means whatever they're trading, they do want that to go up in price. So if they're trading Apple stock, for example, most people are happy when it goes up, and most people are unhappy when it goes down. This seems to be the comfort level of most investors. But there is more to the markets than just going long. This is a 20-year chart of the S&P 500, and you can see that while there is a long-term uptrend in the broad market, it does go down as well. Sometimes just small corrections, and other times major recessions. So to be the most profitable trader you can be, you do have to have systems in place to allow for some short positions as well. I know it's been a very long bull market, so sometimes people forget this, but sometimes being bearish makes money as well. And that's what I'm going to talk about today. I'm going to show you one of my go-to trades for strategically taking short positions, and it's called the short call vertical. So smash that like button for me, subscribe to the channel if you haven't done that already, and let's get into it. So this is what the risk profile of the short call vertical looks like. Now in just a minute here, I'm going to open my trading software and go through a full example. But first, let's go through a hypothetical trade just to get familiar. So we have stock XYZ currently trading at $50. And we're going to sell a 50-60 short call vertical for $5. Now this vertical spread is created in a single transaction by selling a $50 call option and then buying a further out of the money $60 call option against it. And by doing that, it caps both the maximum gain and the maximum loss. Looking at the maximum loss first, with this trade, no matter what happens, even if the stock or index you're shorting keeps going up, you can still only lose a set amount. That maximum loss is calculated by taking the difference in the strikes that were chosen, subtracting the premium collected, and then multiplying by 100 because each one option contract represents 100 shares of the underlying. So there's a $10 strike gap between 50 and 60, subtract the $5 premium, multiply by 100, and no matter what happens to this trade, the maximum loss is $500. And for the same reason, the maximum gain is capped as well. On the gain side, it is just the premium collected times 100. So in this example, we have a maximum gain of $500 as well. That's why this is such a useful trade. Risk management is easier here because you know ahead of time the potential outcomes, so it's just a trade about position sizing. The option Greeks are statistical values that provide us a way to measure the sensitivity of an option's value with respect to other factors. The ones we focus on are price, time, and volatility. Delta is an option sensitivity to price, and these short call verticals are delta negative. It's a bearish trade and they profit from decreases in the underlying. Theta is an option sensitivity to time. Short call verticals are theta positive, meaning they do profit from the passage of time. And lastly, Vega is an option sensitivity to volatility, and these short call verticals are Vega negative. This means they will profit from decreases in volatility, and they will lose value with increases in volatility. So now I want to get into an actual trade here and illustrate these points more clearly. So here we are inside the Thinkorswim platform from TD Ameritrade. Now remember, the short call vertical is a bearish trade, so we do put them on whenever we feel something is overvalued. Since I mentioned Apple in the introduction here, this is Apple stock over the last 1 year. And I don't think there's any question that this has gone up a lot in price, right? From something about 160 up to 327, this is a massive increase in price. But an area where people will disagree is whether that means it's overvalued or not. Remember, price and value are not the same thing. Just because something has gone up a lot doesn't mean you jump in and short it. And in this case, just given the massive momentum with Apple over the last few months, I certainly wouldn't want to stand in front of this thing with a straight up short position. But the short call vertical, that would be an excellent way to play this. So you would set a line somewhere up here, and you're taking a measured position that perhaps Apple is going to run out of steam and maybe go down a little bit. You don't need it to crash or anything, but maybe just plateau a little bit and drift lower. But for my example today, I'm actually going to show it on something else, which is volatility ETPs. The two of them that I use a lot are VXX and UVXY. Today I'll use VXX. So this is a long volatility product, which has an inverse relationship with the market. It's not an exact correlation, but more or less when the markets are going up, volatility will be going down, and products like VXX will be crashing. A lot of people think this means that the VXX is somehow broken or manipulated. It's certainly not. That's just how long volatility works. There is always a decay factor. The chart would look very similar to this if you were to just plot a 1-month long volatility option, for example. It would be decaying over time with certain periods where it spikes up. That's perfectly normal. So the VXX is not manipulated or broken, it's just designed this way because that's how long Vega works. But you can see that the general downtrend is sometimes interrupted by a few little spikes. And we've had one recently here with the coronavirus, so VXX is up off the lows here. I certainly don't have a functional crystal ball, I'm not saying that I know what's going to happen. But for this example, I'm going to show you how you could use the short call vertical to play for the VXX, an expectation that it will continue its downtrend. So we'll go over the Analyze tab. These are all the monthly contracts that are available. I don't trade the weeklies, I always stick to the monthlies. And given the level of uncertainty, I think we'll go a little bit further out in time, 49 days, and we'll choose this March expiration. Now in Thinkorswim, the calls are on the left, the puts are on the right, and we are selling a short call vertical, so we're going to focus over here. I'll just choose one with a strike slightly inside the money here, and I'm going to sell to open a vertical spread. And this is what that looks like. This is the familiar shape of the short call vertical. Now, just a side note, what you can do to actually reduce your trade fees a little bit is increase this strike gap. So I'm going to go ahead and make this 15 the 16. It's just going to save a little bit of commissions. So breaking this trade down, you can see we have a short $14 call and then a long $16 call. So this is the 14, that's the one that's short. And then over here is the 16, we're going to buy that one long. And because of this contract over here, the $16 call, if you buy that, it does cap both the gains and the losses. So we now know ahead of time how much we can make and lose. Looking at the max loss side of things, first of all, this is a quick and easy calculation. You just take the strike gap difference, the difference between 14 and 16, which is $2, and then we will be subtracting the premium that we bring in, which is the 66 cents. That $1.34 difference is the maximum loss. And then we just multiply by 100 because, of course, every one option contract represents 100 shares of the underlying. So this all makes the maximum loss, no matter what happens to the trade, $134. There could be a massive volatility spike, VXX could go to 50, but the trader who opened this can't lose more than $134 per contract. And then, of course, the maximum gain is capped for the same reason, because we purchased the out-of-the-money long. So to calculate that, it's even easier. It is just the premium we bring in multiplied by 100. So you can see the maximum gain is $66 per contract. So now risk management is very easy. We can plan out our position sizing, knowing exactly how much we can make and lose. Now, one question that always fills up my inbox whenever I do videos like this, people see that the trade is somewhat lopsided. One very simple way we can address this is by focusing on this pink line, which is the daily profit curve. Now you can see when we open the trade right in the beginning, it's going to be about zero, of course. But as the price moves around, the daily profit is going to be adjusted. So you can always get a snapshot of how your trade is doing at any time just by following this daily profit curve. And then something else we can apply to this is a 50% stop loss and a 50% stop gain. This will now equalize both sides of the trade. So if we just take 50% of the premium, that's 33 cents. The stop loss and stop gain would just mean that at $33 profit or $33 loss, we would close the trade. So if you're following your trade in your trading software, what I like to do is just find those points and just track them every day. So we'll find the $33 loss, which is about there, and then we'll go over to this side and we'll find the $33 gain, which is about there. Close enough. So now you can see, in a very quick glance, we know when we're going to be closing this trade. You don't have to use stop losses like this, but I very often do. Today's price is right here. We've drawn our line in the sand. Hopefully it goes this way. But of course, if it goes down, it just means the trade's going to lose money and we'll close it out. But it's always going to be a limited loss. There's no danger to losing more than you're expecting here. This is why we like this trade so much. So we'll just go over the Greeks really quick because they are important. We'll do delta first. You can see it is a negative number here. So at the money, minus $18.72. This means that it is a bearish trade. We want the price to go down. And you can see that in the first chart, of course. We want the price to go this way. It's currently around 1440. We want the VXX to continue its decline and go lower so we can make our money. It's delta negative. The next Greek is theta. Now, of course, it will depend which side of this you're on, but typically short call verticals are theta positive. We're starting the trade right here. Let's just say for the sake of argument that VXX was just pinned on the current price and didn't move for a month. Since we are a little bit positive theta, what would happen is that this would tick upwards towards the potential gain. So there is a little bit of positive theta there that we can collect every day. And the last Greek is Vega. Vega refers to volatility. And again, it's going to depend where you are and what the cycle is, but these trades are slightly Vega negative. Now, because we're selling and buying an option contract in the same spread, there is a little bit of cancellation there, so the amount of vega in between those two strikes isn't as much, and it makes it not quite as important as most single leg options. But it is something to pay attention to. Ideally, you do want to open these trades when volatility is a little bit elevated. That will leave a little bit of room for it to drop. And currently, right now, as we are seeing, there is a little bit of increased volatility in the market. This is the VIX index, and you can see we're up a little bit. It's not crazy high, but if you want to have a little bit of a vega headwind, this would be a better time to be on the short side of trades, like a short call vertical. But that's the trade. It's pretty straightforward. Essentially, it amounts to just drawing a line in the sand, wherever you are, and saying that we are expecting it to at least plateau and perhaps start fading downward again. So we've seen the little VXX spike. Not to say it couldn't go all the way up here. Of course, it certainly could. But as traders, we do have to pull the trigger, and I think this is a reasonable time to open it. Now, a lot of my trading is volatility specific, but like I said, this could apply to just regular stocks or regular indexes as well. It works perfectly well just doing it on Apple here. It could work well on the S&P 500. There's lots of things that are high in price right now. Again, like I said, not necessarily overvalued, but certainly high in price. So short call verticals, make this trade part of your regular rotation, use those stop losses, and it's actually a very good risk-reward profile here. So just to review the important points, the short call vertical is delta negative, meaning it is a bearish trade. Whatever you're applying this to, you want the price to go down. Typically, they are theta positive, making them higher probability trades. If the underlying you're trading just hangs out in a range, the profit will build up slowly over time. And these trades are vega negative, so ideally you do want to be opening them when volatility is a little bit elevated. Now that's not always the case on those high-flying stocks, so that's why you can sometimes look to apply these to the volatility ETPs as well. When those are spiking up in value and you want to play for a possible reversal, this trade is very effective in that situation as well. And lastly, these trades are both limited gain and limited loss, which makes risk management pretty straightforward because we know the outcomes ahead of time, and then it really just becomes about proper position sizing and using those stop losses. So if you're interested in this trade and many other option types as well, head on over to my website, claim your free trial to the VTS Options community, and come follow some of our live trades. Thanks for watching. So if you're interested in options trading, go claim your free 2-week trial on my website. In that time frame, you'll definitely see a wide variety of trade types: iron condors, strangles, calendars, earnings plays, pairs trading. I have many profitable strategies that you'll be interested in. Come join the VTS community.